code to implement the initial berm suggestion has been approved and is now being implemented, with this ongoing and the crucial date of August 22nd approaching. When we reach the block height and get the 1.2% burn implementation plus a number of additional implementations, including re-enabling staking and kick-starting the blockchain, the burn is already mounting. Our discussion today will center on the implications of this development for the likelihood of the proposal's passage, as well as the implications of this development in relation to the other upcoming burn proposals. Okay, so let's jump right in. So, we are aware that a few days ago, we discussed the re-enable staking/delegation, a crucial component for the large resurgence of fear in a classic, and a number of other recommendations, among them the 1.2% burn proposal to be adopted. The date of August 22, 2022 has been established as the day the block height is reached, and many of these recommendations, including the burn proposals, are implemented. It is stated here that the creation of new validators will be disabled until block height hash 8,905,758, which is expected to occur on or around August 22, 2022. Once these validators and this block height have been implemented, not only should we get staking such delegation, which actually incentivizes people to build on the telling, but also the classic blockchain will provide us with staking, allowing us to actually function as a blockchain since it is a proof-of-stake chain, and then allow that. In addition, we really ought to get things going when these things are finally put into place, as we have been hearing so much about them. What will happen to the price? Will there be an automatic price pump, as some have speculated? To what extent will this process cause a mad burn, if at all, or how does it function? Well, we've got a wonderful breakdown with a variety of Happy Cathy sources, including our pricing and burn computation in the Excel file related to the various burn percentages. What can we expect from the burn if all of these recommendations are implemented simultaneously? This, plus a bunch of other math that gives us a rough idea in terms of current volume. To be specific, the burn area alone is currently averaging roughly 150 million cubic feet per day. To sum up, if all recommendations are executed, we can receive around $24.36 billion every day, or $731.1 billion per month. In addition to the 1.2% annualized burn rate, the proposed ATO would also expend 50% of all transaction fees based on the number of transactions rather than the number of tokens sold. Now that we have learned that the 1.2% burn mechanism is where the real volume and burn come from, we can confidently propose a weight. Even though the other one only is half of the community pool, that's still millions of dollars. These deals aren't that big of a deal because all you have to do to complete them is take the transaction fee typically paid by each buyer and seller in a traditional trade and put it in a classic. Since the transaction charge is roughly the same whether the amount being transacted is 1 cent or $1 billion, the 1.2% is the key figure to focus on if you expect your transactions to pile up quickly. The 1.2%, however, is a percentage that increases in relation to the Luna that is being bought or sold. This is the point at which the supply can be reduced to the levels proposed in the beginning, say 10 billion. Will this fire continue? And will the supply decrease immediately when the re-enable condition is met, meaning when this blockade is reached and all the suggestions are successfully implemented? The 1.2% burn will be applied to all on-chain purchases and sales. The quantity in circulation will undoubtedly drop immediately. Of course, a burn wallet isn't literally pulling it out of the total supply in terms of the total supply. Thus, it may not obviously decrease in something like CoinMarketCap if CoinMarketCap hasn't already recognized the burn wallets. Even if the total supply isn't changing, the amount of tokens actually in circulation is, since they're all being sent to a dead or wallet, which is really simply a random moon wallet from which no funds will ever be withdrawn. Yes, as I said, this means that the total amount in circulation would gradually decrease. There's some doubt as to whether or not this will increase the market valuation of European coins, but the amount in circulation will certainly be shrinking, and shrinking at a respectable clip. It is not acting erratically at the present time. Our current volume is barely about $52 million. So, if you plug in 10 million transactions every day at the present pricing, which is a little bit lower so we can buy more, you get what I mean. Based on the 8 calculations I made to price out the 5 and 6, we could estimate a range of about $2 billion if we did a little bit of work. Therefore, we could process roughly 10 billion tokens every day, give or take 10 billion phrases per day. Given the current rate of business, naturally, both the price and the volume of transactions may increase or decrease from their current levels. And we also know that if the supply and circulation is reduced, prices will rise. Therefore, it will be able to purchase back and burn fewer tokens due to an increase in price if the volume does not increase proportionally. But we can get started and prepared in the first week. A really bad stinger, actually. With any luck, the first week will see the equivalent of tens to hundreds of billions in transactions being burned. It's also important to think about the fact that the proposal's launch date, August 22nd, is around 2 months away. 2 months from now, the cryptocurrency market's future is completely unknown. Over the next 2 to 3 years, the global economy seems likely to enter a phase of sluggish growth. Since Bitcoin and other speculative assets are heavily tied to falling stock market indices like the S&P 500 and the Nasdaq, we know they won't do well during a recession. Then Bitcoin came along afterward. There hasn't been a relief bounce for Bitcoin or the market as a whole, but that could change by that time. We may or may not be witnessing the beginning of the prohibition on lunar classics. Having so many proposals being put into action at once has caused a slight market relief rally. It's possible that a bear market may last for at least another year or two. However, we might get a 2 or 3 month head start to get Terra Classics fire started. I still think there is a lot of enthusiasm about crypto, and we haven't seen a significant drop in transaction volume. Some of it has been drained out. But I believe the natural FOMO will still occur in crypto if we see a lot of excitement and transaction volume coming. Perhaps not quite as much though. So, let's cross our fingers that the current Terra Classic burn will coincide with a little renaissance. Without it, it might not have as much of a jumpstart as we'd like. And now, in addition to the burn, it's crucial to discuss the other advocates of these other proposals and the effects of staking delegation and higher rewards for proposal validators. Therefore, the staking, when applied at the current block height, will improve the efficiency of the chain. We also plan to offer certain validators or a redistribution of transaction fees, which we know will be helped along by the weight suggestion. Furthermore, as you can see, 10% will be airdropped to ecosystem devs and 5% will be preserved for core classic development, which means that there will be more development on the actual chain, resulting in a larger growth in the value of the blockchain. With any luck, the daily transaction volume will also increase with the help of intrinsic demand, adding fuel to the fire. However, we should also keep more for Terra Classic development.